Gonna try to fly through the Flood Disaster Protection Act because this is the second time I've read it. Out of the Reference Guide to Regulatory Compliance on page 173. The Flood Disaster Protection Act prohibits federally regulated lending institutions from making, increasing, extending, and renewing loans secured by buildings or mobile homes located or to be located in a special flood hazard area of a community participating in the National Flood Insurance Program unless the property is covered by flood insurance. The principal purposes of the Act are the following: to provide adequate amounts of federally subsidized flood insurance to owners of improved real property located in a special flood hazard area, and to provide a preventative alternative to massive doses of federal disaster relief funds normally made available to flood-stricken areas, to reduce loss by working with participating communities, to require proper construction and land use practices. Those are the three principal purposes of the Flood Disaster Protection Act. Each agency implements its own flood regulations. The Federal Reserve Board implements this statute through Regulation H, membership of state banking institutions in the Federal Reserve System. The Comptroller of the Currency has its flood regulations in Chapter 22, and the FDIC's regulations is found in Chapter 339. In 2011, the OTS was merged into OCC as a result of the Dodd-Frank Act, and the OCC converted the OTS flood regulation from Chapter 172 now to Chapter 22. The agency's flood regulations had remained essentially the same for almost 2 decades until the passage of the National Flood Insurance Reform Act in 1994. Reacting to increasing flood insurance claims, Congress made sweeping changes to the NFIP, including the extension of the waiting period before flood insurance takes effect, expanded flood insurance coverage, the addition of civil money penalties for violations of the law, and the requirement for banks to escrow funds for flood insurance if they escrow funds for taxes and insurance, and the mandatory forced placement of flood insurance if the borrower does not keep insurance in effect on a covered loan. In response to the change in the law, FEMA, the Federal Emergency Management Agency, issued a joint rule revising the flood regulations. The revision became effective in October and November of 1996. The bank regulatory agencies issued guidance in May of 1997, and the FFIEC, the Federal Financial Institutions Examination Council, published interagency questions and answers in 1997. In September of 2007, the bank regulatory agencies issued new guidelines. FEMA issued an updated version of its mandatory purchase of flood insurance guideline. While the law itself did not change, some of FEMA's requirements were amended, and in 2009, the banking agencies updated their interagency questions and answers regarding flood insurance. Coverage. Designated loans. All loans secured by a building or mobile home, including increases, extensions, refinances, and renewals located or to be located in a special flood hazard area where federal flood insurance is available. It's not limited to consumer or mortgage loans, meaning that it also covers commercial, and it includes table-funded loans, which are loans that are settled by a contemporaneous advance of loan funds and an assignment of the loan to the person advancing the funds, and is triggered by the collateral and not the purpose of the loan, and includes improved property taken in an abundance of caution, and also includes home equity and secondary mortgage loans. Properties that can be covered include the following.
Look at the deer back there.
Walled and...
Come in here and look at the deer back there, Manny's, right past the garden.